Hello, everyone, and thank you for taking the time to join Cobalt Blue for this investor webinar. Today, you've got me as your host. My name is Joel Crane. I'm the Investor Relations Manager. I'm joined by our CEO, Joe Katarevic, and our Executive Manager, Andrew Tong. The intention of today's webinar is to discuss the contents of the strategic update we released this week. It included the update of the progress of the Broken Hill Cobalt Project DFS, also details on the study of our proposed cobalt nickel refinery in Western Australia, as well as the results of the positive test work with the samples from the Pung Fung mine in Canada. So with that, I'm going to hand it over to you, Joe.
Thanks, Joel, and good morning, all. It's an exciting time for the company. The strategic update, I think, shows a very strong signal to the market of where we want to be positioned in the longer term and highlights the building blocks of this business. And just to reiterate, the building blocks of this business are a refining business, the Kwinana refinery, which we'll touch on shortly, the Broken Hill Cobalt Project, an extraction business, if you like, and also our waste streams business, which is getting quite a bit of momentum of late, and we'll talk about that shortly. Perhaps if I can talk to, firstly, the cobalt nickel refinery. The ASX piece released on Monday has quite a lot of detail about it. For those of you who wish, please have a read through it. It contains all of our key assumptions, all the basics of the business model, and of course the economics that spit out of that. Put simply, from a cost point of view, we are in process for the next 6 or 7 months with respect to mid next year to doing some pre-work ahead of capital and construction. There's about $10 million being budgeted for that, some of which has already been spent and is being spent today. For example, the upgrade program with respect to larger scale test work of third-party feedstock. With respect to the construction numbers, they've printed at 47 million plus a contingency, which we've allowed for the total package, including the pre-construction work, somewhere around the 70 million Aussie number, which is an excellent number in this inflated environment. And it's an excellent number that reflects the strong attributes of the site that we've selected in terms of lowering the costs of building this facility, and reflects all of the tie-in points and power, water, etc. that site offers us. Put simply, on a long-term basis, we believe this refinery can generate post-tax returns in the mid-20% and above, and even on today's depressed market with respect to cobalt pricing, would still generate that style of return, and NPVs ranging in the triple digits and flexing up. In none of the key parts of this announcement have we tried to ascribe an IRA premium or a premium to do with the Inflation Reduction Act. We have various quite bullish thoughts on how that will interact with our model, but overall we've kept it as a conservative baseline without those numbers. And we ultimately, if I can just flick to the next slide, Joel, what we want to do is move into becoming a top-tier global producer of cobalt chemicals, particularly cobalt sulfate. And this slide here shows the interaction between our extraction business and the refining business across Australia, the potential to then put other extraction businesses such as waste streams, mines and other sources into that, but also work with third parties for their feed. Some of those third parties potentially will be Australian source material. Other third parties may be other countries. And I would reiterate, the target being an IRA market would mean that we would, under the FTA carve-out, that this product will be applicable for IRA and particular clean vehicle credit subsidies for the end customer. So that's the key here. We're taking advantage of the geopolitics. We're focusing on bringing a production chain into business, not just a necessary single asset. And we're going to deliver this on a plate to those key markets, which we're already getting some very good feedback. With respect to the right-hand side, it just shows you that you don't necessarily have to be a large player to be significant in this space, given the dearth of Western world investment in the last 30 years. So we intend to occupy a space somewhere around that top 10 mark once we consider both stage 1, which is the third-party production stage, but also stage 2, which then integrates with the Broken Hill mine. Thank you, John. The next point I want to touch on is the waste streams business. Now, our collaboration with Hud Bay Minerals with respect to their Flin mine is probably front and center at the moment, given that we signed a test work arrangement mid-year and have recently provided an update last week. The update, and I would ask you to have a read through it. There's now some nice granular detail for those looking for scale and opportunity. It does talk about the fact that we've successfully achieved a 90% sulfur recovery. That's important in this case because it's all about taking the sulfur out of that waste stream, because sulfur is the key element of sulfuric acid production later on. So it's all about desulfurization, but it's also, from a commercial point of view, includes metal recovery. So a 90% recovery of sulfur is a really good start point for that. The release also talks about the metals content, including zinc, copper, and lead, and it alludes to some gold and silver in the narrative. But those numbers, combined with the scale of the opportunity at 100 million tonnes, for those clever analysts out there, you can start to ascribe some value in terms of gross revenue. We're not going to get into that business of pounding the table on what that looks like, because it is somewhat misleading. What we're really focused on is the margin and ultimately the value that we can get out of that for our partner, and hopefully, if negotiations are fruitful, include ourselves into that downstream. So overall, that's a very positive relationship. And next steps from here are some finalisation of this current stage of test work before, if successful, moving to a larger scale proof, possibly not dissimilar to our own journey at Broken Hill. And then, if that's successful, potential commercial negotiations. But this thing's coming at us fairly quickly, and I think both partners want some clarity around the framework between us. So that's Flin. I'll head over to Adrian now.
Yeah, thanks, Joe. Thanks, Joel. Great to be with everybody today. I was going to spend a couple of minutes talking through the strategic plan with regards to the refinery. Before I move into that, it's just worth making a few comments around our Broken Hill project, and then that sort of puts the context to the refinery. If you've had the chance to read through our strategic updates that we put to the market on Monday, you will have noticed that our Broken Hill feasibility study is now aiming to be released in April next year. So we're working through the final cost optimizations for that. So we've got a lot of information back from the consultant engineers, Worley, SRK, and GHD, and we're now working through the integration and cost optimization programs so that we can publish the best opportunity there in the DFS to take that project forward. So there's been a little bit of a process there to get those costs together, and one of the big issues for us that we're working through at the moment is what's our preferred execution strategy in terms of the people side of that project. How are we going to build it? What sort of team we're going to use for the construction side? Is that a full EPCM model? Is it an integrated owners EPCM model? And so on and so on. So there's quite a bit of work done beyond the receiving of the documents around equipment or the design of the civils. It's now all about how do we construct this in the most cost optimized fashion. Let's just talk through this refinery program here. We've got a series of steps here on this timeline chart. Essentially, we've just completed our study. That study gives us the basis for defining the permitting. So now we can go ahead and complete the permit studies and then submit those next year. Importantly, if we are able to complete our negotiations for our preferred site, then that site already has operating licenses at the moment, and the permits will be a modification to that. So it's not a clean start beginning in terms of permits. It would be a modification to the existing permits. We've already been negotiating with West Australian regulators around what those changes would be. So we've got a very clear path. Our current engineering study that was completed recently gives us a basis now to go and do those permitting studies, truck movements, emissions, waste, and so on and so on. That study also gives us a basis to move to detailed engineering design, particularly around the civils and structurals and electricals. So while in the study we defined our flow sheet, we went and costed out all the direct equipment, we had to then make some assumptions around our 3D layout. We've now got to go and actually complete the detailed design of that 3D layout and then take that to market in terms of the pricing of the steel and the concrete and so on. So that's really what the detailed engineering design is going to focus on. We're able to then move ahead with our contract negotiations for feedstock. So Cobalt Blue, through this work, has been negotiating a number of potential supply agreements. We've gone and secured some 5-ton samples out of those negotiations. One of those is about to be processed soon in our Broken Hill facility. And so once we complete those 5-ton samples, then we're able to use that information to confirm contract negotiations. So we'd like to be doing that early next year. And then once we have those in place, then we can really start to build out the financing of the refinery program. So there's a lot to get done in the next 6 months around that refinery program, but it's all based on the fact that we've now completed this engineering study and we're able to have greater confidence in moving ahead with the project. Thanks, Joel.
Thanks, Andrew. We'll shortly move on to question answer session. Before we do that, I might just quickly touch on what's happening in cobalt price. It's obviously quite pertinent to what it means to us in the broader market. Look, prices have remained in a relatively tight range throughout this year, and that range has been at the lower end of the historical average. We've talked about it a lot in the past. I'm sure keen observers of our company in the cobalt market understand the reasons behind that, but just to reiterate, it really is because of a larger than expected supply growth, which has outweighed demand growth. And that's really been in place since 2022. And of course, also this year, and it's going to likely occur through much of next year as well. Just to be clear, this is a supply issue. EV demand remains quite strong. And importantly, EV demand remains very strong in the markets that matter to us, and that's Europe and the US, where growth is actually now the fastest in those two markets than anywhere else on Earth. So again, just this outweigh of supply growth or demand growth is what's leading to these lower prices. When will this trend end? Of course, is the key question. As I said, it's likely to remain into next year, but there are some important caveats that we're already starting to see discussion among major producers of cobalt about managing supply. We had an announcement from Glencore just this week about some issues with one of their facilities in the DRC and across many of the global meetings, particularly the copper meeting in China over the past couple of weeks. A lot of those major producers in the DRC are talking about managing supply as the copper price comes down. Obviously, cobalt price already down. So this is typical behavior you see of major producers at points in the cycle like this, where we're now well and truly 18 months into a lower price cycle. So as we enter the end of this cycle, our modeling shows that demand growth will start outpacing supply growth from around the second half of next year. And then into 2025, really sustainably does so. And of course, that is quite advantageous to us because that essentially coincides with when we're starting to ramp up our production and revenue generation. So it's actually a very exciting time for us, despite a lot of this malaise around the cobalt price itself. Okay, we'll wrap up at this point, and I'll just jump into some Q&A. Looking across the questions, most of them are around details of the refinery, a few around the waste streams project. But maybe just before we do that, a couple of questions just on the Broken Hill Cobalt project DFS. Essentially, I don't know, Andrew, maybe you can just give a little more detail. You said it's we're targeting April, but a lot of questions on it. Has this DFS been delayed indefinitely?
Simple answer is no. We're not delaying it indefinitely. We're very keen to complete the DFS and get it out to market. The reality for that project, like all mining projects at the moment, is there's a lot of cost pressures on those. And then there's just in terms of coming out of post-COVID cost pressures. But the biggest issue is really around the execution and how to time that project with respect to the cobalt market. And Joel, you've just shared a couple of minutes on where the cobalt price is at the moment and when cobalt price is expected to appreciate. So for any mining project, not just Broken Hill project, any mining project, we've got to make sure that we time the run to that to suit the metal commodity. In our case, we're looking through the cycle of cobalt, and we're trying to work through A, the costings today, B, what the costings might be 1 year, 2 years down the track as we move forward. Because once we complete this study, the aim of that is to use the study to then secure the finance for the project. And so the two are tied. It's no point us completing a study with equipment pricing. We actually have to work through the construction side of it. And the construction is heavily tied to the financing in terms of the availability, or the terms for debt are related to warranties, execution risk, those sorts of things. So that's really what we're focused on, is not just pushing out a study with numbers in it, but really making sure that that study can be used effectively to get finance.
I think that's very clear. Thank you, Andrew. Well, we've got you, Andrew, in the spotlight. Can you give us a little more details around the agreements and commercial negotiations for the feedstock for the refinery?
Sure. Obviously, I can't reveal any names. It's all commercial in confidence at the moment. But broadly, what's happened is that over the last 18 to 24 months, as we've been out in the marketplace talking cobalt to groups all across the world, what's very clear is that there's a lack of midstream processing, particularly in the Western world. So sort of the ex-China processing hubs just don't really exist at the moment. There is some processing, so I acknowledge that, and I acknowledge a number of really good companies doing work in that space. But particularly in Australia, there's a lack of midstream processing for cobalt. And so what we've been encouraged by various groups across the world, and also within Australia as well, is to really push as hard as we can into that midstream supplier refinery mode. And as we've done that, then there's been a whole range of possible feedstocks that we've explored. So credit to our guys within Cobalt Blue. We've gone and put up a whole list of opportunities there. And then we've gone out and met with many of those groups and talked about their current existing sales channels, and then the need to divert some of those, either commercially or regulatory pressures on that. So I'll talk both on those comments. Commercially, there's desire to have more than a couple of channels or intermediates. So the typical supply chain, large cobalt hydroxide out of the Congo goes effectively largely to China for processing. So commercially, those producers are looking to diversify their sales channels. And then regulatorily, I'm talking about things like the US IRA and the EU legislation wanting diversified allied supply chains, and their pressures again to find alternative midstream refiners. So there's a number of options there that are coming together, and the confluence is our midstream strategy to build a refinery in Western Australia, which is on a lot of those supply chains, both within Australia, West Australian mines, access to Southeast Asia, so the mines around there, or to African mines. That's a great location to be based in.
Maybe one more sort of detailed question on the refinery, Andrew. Sort of surprising comments surprised. Why is the capex so low? It's sort of nominated a number of 50 to 55 million Australian. Given Australia's sort of reputation as a expensive place to build, or maybe even more to the point, why aren't there other midstream refineries in Australia? How did this come in so low?
I think there's a few elements to that. Number one is that we've priced it out with a view to using an existing site, and that site has a lot of infrastructure already in place. And so that's a significant value add to us, is to work with that site. So there's obviously a lot of background negotiations still continuing. But if we can secure that, that's a huge win for us in terms of minimizing the capital outlay. The second is just to consider for a moment the scale of what we're trying to do. At roughly 3,000 tonne cobalt a year, it turns out to be a couple of tonne of product an hour. So it's a relatively small equipment, even just for the commercial side of this business here. So that all comes back to effectively putting the entire refinery into one large shed. It's not quite as simple as that, but basically it's one shed development. It's not a mine site development. It doesn't have all the civils and structurals to do with a full mine site upgrade. This site has power, high voltage power into it. It has water already, mains connected. All of those sorts of things mean that we're effectively just building out one shed, and that all contributes to the lower cost estimate at the moment.
Taking the spotlight off you for a bit, Joe, there's a lot of questions regarding basically just when can we expect updates on the Japanese partner, and also maybe just can you comment a little bit about the investment, not only from our current partner, but just from what we were hearing, sort of the separation between the mine and the refinery. Our potential commercial partner is more focused on downstream than the upstream right now?
Yeah, thank you, Joel, for the question. It's a good question. Look, we need to be, we're looking at the larger prize here. The larger prize is ultimately a successful operation in the short term in Kwinana refinery area, and then the larger prize for Broken Hills to get that into operation. So every step we make from this point isn't designed to necessarily provide the clarity that some investors would like, but it is designed to have a stepping stone of creating a commercial outcome. So in the near term, we are focused on creating a binding arrangement between parties. Part of that binding arrangement will then lock down the economics. So, for example, what business model are we in terms of refining? There's that issue of tolling versus merchant refining. For those familiar with refining terminology, one model means you just charge a margin on every metal product that goes through, and it's somebody else's metal. That's a lower return type model. The other model is you own the metal and you take that whole uplift of that value you create into the market. So there's a discussion over that. Our preference clearly is the latter because it's a better business model overall. We do want to name the partner, have that ability, but sensitive to their brand. If it's a well-known large trader of in this space, and when they're good and ready and have that confidence, I would say to the market that the delivery of the study provides a substantial amount of that confidence because we now have the technicals. What the market doesn't see is the 350 pages of study documents behind that ASX announcement. So I get that a lot. Where's the detail? Well, the detail's effectively commercial and confidence and has been shared. So once that confidence builds, once we know a little bit more about the test work that Andrew's talked about, I have little doubt that we'll get into a position where we can create a more binding arrangement, and with that will be the announcement of the partner. We understand that creates certainty. Slightly different point to add as well, we're also going through an IRA verification process. So effectively our internal analysis shows that as an Australian refinery, we can take either Australian product or selected overseas product for IRA compliance. What we're doing as a next step is getting an independent view on that as a concept. And ultimately next year, that will involve engagement with US government because we want to verify the business model right out of the gate, have it basically approved before we get into production. And the last question with respect to how the partner views it, look, the partner is clearly engaged with us on the refinery. We're looking at similar story on the mine side as we get closer to delivery of that substantive piece of feasibility work when you need to create those relationships and announce to the market. And I would say on behalf of the partner, they are also a very strategically focused business. So for them, it's the bigger prize that counts, not the smaller stepping stones.
Thanks. We're starting to run out of time, but we certainly want to spend some time talking about the waste streams opportunities. A bit of questions around the actual scale of the Flin Flon Hudbay opportunity. And are there talks for other similar type test work among other entities?
Perhaps we can both take it. I can take Flin Flon. I mentioned earlier that you can, with a calculator in 5 minutes, you can work out roughly the scale of the gross revenue opportunity. We've been cautioned, and our own natural cautiousness as well, that you don't want to necessarily create any form of value proposition from that. But what we are looking at clearly on the longer term is how to get margin on that. So it's a multi-headed economic model. Partly the desulfurization allows Hudbay to effectively lower their liabilities going forward. That's important. That's important not just from a financial perspective, but also from a town and environment perspective. They're a very socially focused business, so we like that about them. But also we're looking at going forward more test work with them, and with that test will give us more confidence with respect to what the economics will start to shape up. But we're some way before we can even make those initial assumptions. Globally, from a waste streams point of view, we've started engaging with the European Raw Materials Alliance, and they're a gateway to the EU Commission and being introduced to waste streams projects within Europe. One of the first cabs off the rank that we'll be looking at is the Iberian Pyrite Peninsula. So that's the Spanish copper pyrite area where there's hundreds of years of mine tailings sitting there at surface. Tailings that were produced decades and decades ago are likely to have more generous assays of metals in it because the processing technology wasn't that particularly sophisticated. But that's an area we're looking at for introductions, and we'll build. Flin-Flon we've touched about. Closer to home, we are looking at opportunity sets in Queensland. We have we're in active discussions, and also in discussions with a broader array of players with respect to what Queensland will look like post the close of the copper mine at Mount Isa and potentially the closure thereafter of the smelter at Mount Isa. That has implications overall in terms of sulfur and sulfuric acid needs for the state. But that's very early days, and we'll update the market as updates come to us.
Okay, thank you. We're just about out of time, but there have been several questions just focusing on that IRA compliance. So maybe we can just sort of wrap up on that because really, as we try and detail in the releases we put out recently, particularly regarding our strategy, is that we really are trying to pursue this midstream segment of the market because that's really where the biggest lack of material is, not only in the future, but really right now. So maybe, Joe, we can wrap up on sort of commenting on why are you so confident that our material will be IRA compliant, and what sort of competitive advantage does that give us?
Yeah, thank you. Why are we confident? Well, our internal analysis is very confident because if you take the literal interpretation of the Inflation Reduction Act as it pertains to clean vehicle credits and the relevant tax section, then it talks about critical minerals being extracted or processed, and I stress extracted or processed in an FTA country. The only other exclusion in that area at a high level is foreign entities of concern. As long as we don't deal with foreign entities of concern, then certainly products that are made in Australia, processed in Australia should be fine. The opinion we're having is really to deal with foreign sourced material and how it complies. But I would say even asking the question into the US jurisdiction right now really stands us apart. No one else globally is pushing this verification to the US, and it's creating, I guess, a fair bit of limelight for us in Washington to say that here is a new project that wants to take advantage of the legislation as the Americans have put out, but importantly, create a production chain. So where the Americans get excited is they want to see an end-to-end chain that feeds US industry, not a singular or stranded project. So I look forward to the opinion. I look forward to detailed discussions that will be had on our behalf with Treasury and the IRS with respect to that verification. And at this stage, I'm confident that the model is there and we'll get backing. Thank you.
I think, Joel, if I could just add, it's really important when those sorts of questions and topics come up, just to always recognize the context of the US IRA or EU and other legislation like that. It's only targeting a segment of the cobalt market. So it's not like the entire cobalt market suddenly has to shift to compliant material. They're only after a percentage, and I'm not going to say what that is. It'll vary over time. It'll only ever be a segment of the entire global cobalt market. And so this ties back to Cobalt Blue's strategy. We're not trying to be the biggest refinery or take on global refining or have our mine at the lowest cost out of all the global cobalt mines. What we're trying to do here is put our product into that very niche regulatory framework that requires certain characteristics that go alongside the cobalt units. And those characteristics are Australia-made, Australia processed, as Joe said, extraction or processing, high ESG, low CO2. Those things where those qualities and characteristics are valued will only ever be a segment of the market. And that's what we're targeting through our strategy.
Great. Thank you, gentlemen. We'll just wrap it up from there, but that's a great way to sort of end it. I mean, that's really what this company, since initiation back in 2017, was really all about. Australian made, and that really just sort of sells itself. So I'd like to thank both of you for joining us. I'd like to thank all of you out there for joining us, in particular our existing shareholders who've stuck with us through this, shall I say, exciting ride over the past several years. And to any potential new shareholders, welcome aboard and hang on. It's really exciting times ahead. With that, we will end the webinar. Thank you, everyone.
Thank you.